At the start of the year, I released this video revealing my entire dividend portfolio. Following the principles of Warren Buffett, I grew the portfolio to over £300,000 in 13 years. But what's happened in the first 3 months of 2022? Hopefully this video will explain. This is not financial advice, I'm simply showing you what I've been doing in the hope it will help you think about your own financial journey. Please do your own research. I invest in mainly large cap UK companies which pay reliable income streams. I hold for the long term and reinvest the dividends. I use the Barclays Smart Investor platform and make good use of a stocks and shares ISA. So let's see how we got on in the first turbulent 3 months of 2022. I'll describe the performance of each sector starting from the lowest to the highest. In the chemical sector, I only have one company, Croda. It's had a disastrous 3 months, and I've only recently bought in because I sense a bargain. This figure shows the average year-to-date price change in the companies I hold in a given sector. It's only based on the companies I hold, not the industry as a whole. This figure shows how much I currently hold in the company. This figure is the year-to-date price change of the actual company, and because I only hold one company in the chemical sector, it will be the same as the figure at the top of the screen. And finally, here is the dividend yield. As I now hold £4,000 in Croda, I would expect to be paid just over £50 in dividends per year. The next worst performer has been the consumer goods sector, down 9%. I have two companies here, Diageo and Unilever, and I've been buying more this year as I don't expect the downturn in their fortunes to last forever. And with Unilever's yield at over 4%, it's very tempting indeed. In the retail sector, I only own Tesco, and it's down 5.7% this year. As I'm a long-term investor, I'm not concerned, and I believe Tesco will do well in the long term. The banking sector within my portfolio has fallen 4%, and I have 4 companies. The first 2 are Barclays and HSBC. Very mixed fortunes here. HSBC has done quite well, while Barclays has suffered because of a regulatory breach. Some may see this temporary setback as a chance to buy, but please do your own research. I'm sitting tight for now. Lloyds and IG Group are also down in the first 3 months of the year. They both pay quite reasonable dividends. Next is an exchange-traded fund. This one is the S&P 500, which tracks the 500 largest US companies and is down 2.4%. Not a great start to the year, but one definitely for the long term. I like buying this one on the dips. And now for all the risers, and we will start with the insurance sector. I own 2 companies, Aviva and Direct Line. Overall, the sector is up on the year, and they both pay impressive dividends. Up 1.5% is my second exchange-traded fund. This one tracks the entire FTSE 100, so if you want greater diversification and don't know what to pick, then an ETF is a great choice. I've also been adding more of this recently. Defence and Aerospace is up 3% this year, and I bought a new company recently. It's Royce. I've been monitoring Royce for a long time and got interested when it dipped below £1 recently. When it fell below 90p a share, I started buying. Let's see what happens when everyone starts jetting around the world again on all those foreign holidays. But as always, do your own research, as I don't have a crystal ball, and often shares are low for a good reason. BAE Systems is up a huge 28% this year, and the dividend yield matches that of the FTSE 100 average. Up 3.9% is the renewable energy sector. I have 3 companies and they are all part of the FTSE 250 index. Bluefield Solar specialise in solar energy and Greencoat in wind energy. As we transition away from fossil fuels, these companies should do well. The year-to-date rises and also the high dividend yields are looking impressive. The third company in this sector is the Renewable Infrastructure Group, which is involved in both wind and solar power. They haven't done as well, but they pay a solid dividend currently of 5%. The utility sector is up 5.6% this year, with National Grid and SSE both doing well. Dividend yields are above average for the FTSE 100. United Utilities is also up on the year, and they pay a dividend of 3.9%. The food and tobacco sector is up nearly 7%. British American Tobacco and Imperial Brands pay very high dividends. Tate and Lyle make food products and have made a good start to the year along with a very respectable dividend of 4.2%. The pharmaceutical sector in my portfolio has risen 11.2% on average. I have two international giants, AstraZeneca and GSK. AstraZeneca in particular has been doing exceptionally well so far this year. The oil and gas sector is up 14.3%, with Shell rising the most here. Hydrocarbons have been in huge demand recently. But the biggest riser of them all has been the metals and mining sector, and I have just one company, Rio Tinto. They are up 23.3% this year, and not only that, but in September last year, they paid out a dividend of £660. So now let's look at the performance of the portfolio. At the start of the year, the portfolio had reached 301k. 3 months later, at the end of March, it was just under 333k. But I did put 11k of new money in, which needs to be deducted from the equation. This means the portfolio has shown a total return of 20,000 since the start of the year, despite the turbulence in global markets. This is a gain of 6.7%. The amount of new money going in varies from month to month. When the market looks overbought, I'll hold some back and save it in a national savings account, so I have extra funds to snap up bargains when they emerge. Inflation has also been a major factor this year, and I've put a bit more in because of this. I'll always have some funds available, however, to buy quality companies at unexpectedly low prices. I'm not trying to time the market here, I'm simply making small adjustments to ensure I have some funds available at all times. In 2020, Buffett had $138 billion in cash reserves, and he always has at least $20 billion ready to snap up bargains if there is a crash. As a last resort emergency fund, I use premium bonds. Click up here if you want to know more about them and how I use them. I'm now going to compare the performance of this portfolio with other indices. To do this, I'm going to strip out any dividends I've been paid so far this year. This still gives me a gain of 5.8%. You can see in this table how the performance has compared to other indices this year. A word of caution, however, I'm probably not going to beat the market over the long term. Some months I will, some months I won't. The high demand for oil and commodities has been largely responsible for my gains this year, but these are cyclical stocks and they are sure to underperform significantly at some point in the future. Having a diversified portfolio with many asset classes is recommended. I'm a strong believer in index tracking ETFs, but when I started this portfolio, ETFs were not mainstream, but I'm gradually getting into them. If I was starting my portfolio from scratch today, I'd be considering these 3 ETFs as a starting point. So what about my performance since I started in 2009? I'm being completely transparent here. In the early years, I made a lot of mistakes as I was learning, and I didn't know what style suited me. Click up here to see the mistakes I made along the way. In hindsight, we're all wiser, but below are the exact figures from the moment I started. I feel that I'm becoming a better investor as time goes by. I've never taken a single penny out of my Barclays platform, so I know exactly how much new money has gone in, and I continue to drip feed money in over time. I'm currently up over 50% if I were to sell everything today. If you found anything useful in this video and want me to do a future update, then please hit the like button. Let me know about your own investing strategy and how the year has gone so far. Thanks for watching, and may the markets go your way.